So we are ready to go. So just to do a little recap on kind of where we left off, we've got into this position originally with the unfortunate scam that we faced, and we're recovering by cutting certain expenses that we talked about before, but then also looking at all the debts that we accumulated. It put us in a high negative cash flow position, and we are now pretty much sacrificing the credit to save the house, the
Right.
car, the solar loan that we have, the home equity line of credit, and then we can talk about this personal line of credit if we want to try and save that. So there's kind of like two options there, but we are uh, no longer paying credit cards, right? Which will
Right.
it'll go from late to then the creditors they'll close the accounts,
Delinquent.
right? They'll close the accounts,
Yeah.
and finally that'll go into collections. And basically that's giving us the time here where we're basically cutting off our credit score. Yes, our credit score is going to tank, but we're in a process where we're not trying to apply for anything. We're going, main goal here is a complete reset, right?
But was the final consequence or was the final result for that, Denzel, the not paying and going to collections? Do I have to to face? I mean, the collection companies, I know they're going to start calling and all that, but what happened if I don't pay that after, I don't know,
Yeah. So
certain period of time?
I think between us not making any payments on the car to them closing the accounts, I think that takes a few months. That's a couple months. And then once it goes into
Yeah,
collections,
like
I
60
think,
days. They told me. I talked to the my bank. They keep calling me about the personal line of credit, and yesterday I finally answered. See what they had to say. They just want me to make a payment. I said, well, I can't right now, but they told me that I'm 45 days late. Once it's 60 days late, they close the account and goes into collections.
yeah,
But after that, they don't. They don't.
yeah.
They,
What is
they didn't say
the
anything else.
monthly payment, by the way, on that personal line of credit?
It's like let me make sure. Right now, with the full amount owed is like less than 300. Let me log in my account quick to
Yeah,
make
check it out.
sure.
Let's see how much we owe currently.
Let's see here.
Probably like a two, maybe 250, and then probably whatever the late fee is.
298.
298.
That's the monthly payment. But
Said
since
298.
I'm 2 months behind right now, yeah, I haven't paid in 2 months. So right now, the amount I'm behind is five. He sent me an email. 535, I think. 535, 538, 538.
That'll bring it up to current, right?
Yes.
Got it. So we're doing a complete reset on the
And
finances.
my income, Denzel,
Yeah, go ahead.
uh-huh. My income is 4,800, but as of right now, because since I talked to the bankruptcy people and they told me that I didn't qualify because I'm making too much, I quit working overtime. Once if I work at least, because they offer me overtime every week, every Wednesday, and they ask me if I want to work Saturday and Sunday. It's optional. I all these last couple months, I've been saying no to the overtime to see where my income is. We just with my 40 hours, and it's around 4,800. But once I start working overtime, if I work just one Saturday, it goes up like $400. And if I work Saturday and Sunday, it goes up to like 1,700 a week if I work both days. So that's why my income is 4,800 only because I've been working only my 40 hours. I wanted to clarify that.
Yeah. So let's get clear on what we want to solve for, what makes the most sense. So one
Uh huh.
scenario, so I'm going to go over the first that we discussed, which is
Uh-huh.
we let the credit die intentionally because it does not matter compared to the whole body, right? So I want you to think about like you just got bit by a very poisonous snake, and the only way to save yourself is cut your hand off, right? So to prevent
Yeah.
to prevent us from losing our shelter, because that is what can potentially be at risk when we're not paying. If we don't pay the home equity line of credit and our mortgage payment, we could lose our home, right? So in order to
Correct.
save that asset, me personally, being in your shoes after getting scammed by an impersonation of me, someone was impersonating me, and boom, they got you for over $50,000, right? Because it's 50 grand plus all the interest that we're now paying, right? In this debt. So now
Right.
I'm thinking, if I'm in your shoes, I'm like, look, I'm gonna let the credit die intentionally, but I'm gonna let it die slowly and without bankruptcy, because I can let my credit die. I can let these things go into collections. And once they go into collections, it takes months for that new collection company to start reaching out to set up a payment plan. By then, that's when you can negotiate a super small payment like $20, $10, $30,
Okay.
right? And then it's just there. It's just sitting
Okay.
there.
So in the end,
That's what it is.
in the end, I'm sorry. I'm sorry. Yeah. So in the end, it has to be paid off. This has to be paid back.
Of course, right? But the point is we're giving ourselves so much more time instead of having to pay to go through bankruptcy for them to do the same thing, right? Which essentially it wipes it all out, but
Right.
now we officially killed our credit and then we have to wait 7 years versus if we go this route with letting things go into collections, I can still recover and rebuild credit without having to wait 7 years, right? The purpose of this
Right.
first move is to do it ourselves, to reset our finances without credit. We're trying to build discipline again. We're trying to understand why did this happen to us in the first place? How do we prevent ourselves from getting scammed again? How can we learn from these mistakes? How do we make better financial decisions again without credit, without leveraging, right? With just simply building
Right.
our foundation all over again. And we're saving the mortgage, the HELOC, the car, and the solar loan. Okay, so that's one option. Okay, and in that option involves sending all of our leftover cash flow to the HELOC to get the HELOC paid down as quickly as possible. The concern that I have is I'm not sure how it works. And this is something that we could ask by calling the mortgage provider, calling the HELOC, the bank there, to understand this position that we're in. Like if I just continue to make the monthly minimum required payment, am I assured that you're not going to call the loan on me or put me into foreclosure or anything like that? I just want to get some clarity there, right? So second option, which could
I
be
think on the
could be
HELOC,
another
I think
opportunity.
as long as I've been paying their, uh-huh, go ahead.
No, or finish your point. Finish your point.
I was saying, as long as I keep paying them and giving them at least the minimum payment on the interest only period, they're fine with that. Once the interest only period ends, then they will gonna start charging me the principal plus the interest payment. So it will be still a couple years.
Do you know how many years left you have?
I'll say 2 years left because I'm gonna be on my third year with the HELOC,
Okay,
and then after that I have 10 years to repay it off
correct.
because
At
it's a
the
15-year loan.
at that balance. Yeah. Got you.
Right.
So second option, right, is we let the credit die We're no longer making credit card payments. Those are all going to eventually close, then go into collections, still without bankruptcy. So I'm closing that door. I'm not looking at that anymore. I'm not wasting my time with that option, right? Again, with that second option, without bankruptcy.
Right.
Then we're making the
Right.
monthly minimum payments on the car, on the solar loan, on the mortgage, and on the HELOC, which is about $800 a month, interest only, right? So just doing that.
Yeah.
And then we would implement velocity banking on the PLOC, okay? And we have
On the
cash on
HELOC,
hand.
the payment is 705 as of right now because it's a variable.
Okay. So
But
705.
the amount due right now is 705. Mm-hmm.
Got it. So in option 2, let the credit die without bankruptcy, velocity banking on the personal line of credit, where we take our cash on hand that you have, 4,500 bucks, we take our income, right? We continue to work overtime, want to maximize income, right? So we want to work overtime in option 2 and option 1. We want to maximize income to produce as much positive cash flow as possible. And then what's happening is money goes into the PLOC, into the personal line of credit, all of our income, all of our cash on hand. Once
Uh-huh.
this goes to zero, then we would chunk from PLOC, right? We chunk from PLOC to HELOC, right? And do that for 2 years, right? With goal to bring HELOC to 50,000 or less, to 50K
Right.
or less. Final step would be to renew the HELOC to keep it revolving. If we can bring the HELOC
Like,
to 50,000 or less before the interest only period ends, and we can talk to the bank and say, I'd like to renew another 5 years. By then, 5 years from now, our property should have appreciated. We've made 5 years of mortgage payments, all right? I mean, 2 years of mortgage payments, right?
right.
And the property hopefully appreciated
Right.
and it went up. And so it created more space for the bank to see, okay, we're okay with renewing this home equity line of credit for you. And then we would transition from a 12.75% debt tool to probably somewhere around 8.5%. And then we would no longer use the PLOC and we'd be using the home equity line of credit to continue to pay that down, right? And then eventually start
Uh-huh.
tackling the other debts. So with option 1, again, is we let the credit die intentionally without bankruptcy. And the only thing we're saving in option 1 is the car, the solar loan, the mortgage, and the HELOC, no PLOC. And we would just be making extra
Uh-huh.
payments. We'd just be making extra payments to the home equity line of credit to get that down as soon as possible. Okay? If that's not
Okay.
the case, right? If we didn't do that and we did option 2, which we let the credit die without bankruptcy, we do velocity banking on the personal line of credit. We give ourselves a jump start by dumping our cash into the PLOC, brings the PLOC to current, right? So that it's not late, cover the late fees. We save the PLOC, we save the mortgage payment, the HELOC payment, the car, the solar. We're paying the monthly minimum on everything. So we're paying the 705. We're driving everything to the PLOC. And we're pretty much doing the same thing as option 1, right? But we're using the PLOC as our mechanism of making extra payments to the HELOC in the form of chunk payments, right? Probably like $6,000, $7,000 chunk payments periodically for the next 2 years to bring the HELOC
Uh-huh.
to 50K or close as possible. And hopefully, in doing that, we want to be able to renew the home equity line of credit, right? So that we could get a better interest rate than what we currently have at the 12.75, right? Meanwhile, while that's happening, we are working overtime, right? So now the third option, which is
Yeah.
which is kind of where you're at right now, and we just need to get clarity on if this is something you want to do, if this actually makes sense. So the third option is no overtime, work less,
Yeah,
spending
because with
making
overtime,
less.
my check goes almost $1,000 more, like 5,400 or something like that. 54, 5,500 with
So
overtime.
gotcha. No overtime, working less, making less money, thinking, you know, like
Mm-hmm.
making less money, okay? Less money with the intent to qualify for bankruptcy, which equals dead credit. So your credit dies. So
Yeah. So
so the
yeah,
credit
the bankruptcy.
dies.
I think the bankruptcy is out of the equation.
Yeah, so do we really want to not work overtime, or should we make as much money as we can? Think big, right? Understand that my credit's dying no
Yeah.
matter what. It's just dying slower, which gives
Yeah.
me the
Correct.
cash flow, and time to save these other assets at play. So, do we
Right.
want to just throw out option three? Do we want to keep that? What are you thinking?
Yeah.
All right,
No, I think bankruptcy is out of the equation. I
all
don't
right,
think I
it's
want to
out of
do
the
that
equation.
anymore.
So we're not gonna do
I
that. So we are
prefer to work a little.
exactly. So I think by spending less money than what we make, and then doing everything in our power to make more money, so we can make up to about 5,400, maybe more. I say we keep doing that. And
Mm-hmm.
I think out of the two, okay, go with either one. But I do think that option two, after back and forth in our emails together, I do think it is a possibility that we could save the personal line of credit because at least with option two, let's say we get to our goal where we brought the HELOC down to 50K. And but
Mm-hmm.
let's say because we have things in collections still and our credit tanked and our credit's down, it's not looking great. What if the bank doesn't renew the home equity line of credit and just keeps it in
Right.
the new loan payment, which will be a higher payment than 705? And in that event, we also lost the PLOC in option one because that went into collections. So then we're kind of screwed in terms of velocity banking. We wouldn't be able to do it, and then we would only be doing extra payments on the home equity line of credit to pay that down. But we would have no leverage. We'd have no liquidity anywhere, and so that would really hurt. So I'm thinking that if I'm in your shoes, I'm leaning more towards option two, where we could work on the PLOC, restore it before they close it. Yes, we're 2 months
Yeah.
late.
Save,
We
save.
have the money on hand to save the PLOC, pay it up to date, and then pay it even more to it,
Yeah.
right? And then start doing velocity banking.
Right.
The credit limit is 10,000, right?
Yes, but I have a question.
Go ahead.
Do you think that because this just happened to me? I had a credit card with Home Depot, and my credit limit was like $4,000. But I think they check my credit periodically, and since I think they noticed that am behind in some payments, so they reduced my credit limit to 600. So could this happen with the PLOC or the HELOC with my bank?
It could. There could be a possibility. Now, if we're using the PLOC in the way that we're doing, there's a chance that again that might not be the case.
Okay, yeah, because I was been making the payments normal on my Home Depot credit card, and I never. was late on it, I was paid more or uh, more than the limit, the payment, the minimum payment,
Yeah.
and still they reduced my limit, my credit limit bunch from four almost 4,000 to 600, which
But,
is a
but
lot.
I got you, but that's honestly not of concern to us because we're doing a reset on the finances without
Yeah.
credit. So wipe that from your mind. It does not a concern to us.
Yeah, but my question was if that could happen too with my
No.
bank and do that with the HELOC and the PLOC.
Again,
That's what concerns me.
yeah, I get it. But again, it's not our concern. If it happens, oh well. So then we're not doing velocity banking, and that's still
Okay.
okay. That's still okay because we're doing a complete reset, right, on the finances without credit. So
Okay.
that's the ultimate play there is complete reset. With a complete reset, we're focusing on getting the
Right.
income up. Get our income up. Let's unlock our skills, gifts, and talents
Right.
to make 10,000 a month. Right? Get to a place where we can just like write checks and start knocking things out very, very quickly. Start saving money again and start building it up. Okay. So if that happens in the process of doing velocity banking and they reduce the credit limit as we're paying it down and they start reducing it, okay? And if it gets like to where they basically pull it from us, then we would stop velocity banking and then we would transition to infinite banking, right? And we'll build out our own privatized banking system, our own line of credit that isn't tied to credit, right? And
Okay.
that would be the
I
next
I don't know how.
play.
Okay.
Yeah, that would be the next play. So, based on what we discussed so far, are you leaning more towards option one or two now that we eliminated option three?
I like option two because we're saving the personal line of credit and
Yep.
we can use it as a tool. That's that I like it.
Yep.
I
I'm in agreement.
lean more towards that.
I'm in agreement. Initially, I was at option one, but after careful review, I'm like, yep, I think I want to go with option two. And the worst case scenario is, as you mentioned, they lower our PLOC. And if that happens, then it is what it is, right? Like I'm not going to get upset about that. So now let's look at the numbers, right? And we're going to go back to taking those overtime hours because that's important, right? Because that can mean that we're cash
Uh-huh.
flowing. We could cash flow almost $1,000 if we're bringing in 5,400 a month, right? So I'll do income at say 5,000, right? Because I believe we can get there pretty easily.
Okay. Yeah.
Expenses are I'm gonna minus by $95 because now it's at 705. So 4,354.32 minus 95. So expenses 4,259.32. So I'll show that number 705. I'm gonna change that on the spreadsheet.
And if I
Okay.
can even cut more expenses, that would be great too.
That's fine. Yeah, I'm not opposed to that. So just, looking at this right now, and then I'm gonna use a lump sum of say $4,000, which still keeps some money in cash outside of velocity banking. I'm not against doing that. So
Right.
at
Lump sum to the PLOC.
correct, so minus 4 grand
Okay.
would bring the PLOC current, so 5,956. And then I'm gonna show us doing velocity banking starting in October, but we're actually going to start now in September. Okay. And remind me, who is the PLOC with? What bank again is this?
EECU.
Okay.
Same with the HELOC.
Yeah. E.
EECU.
Okay. So do we have our paychecks going to that bank?
Not anymore. I mean, I had it before, but I can transfer it again. I can change my
Yep.
my direct deposit going into that again.
Yep. That's what we want. So we want all income here, and we want all expenses here. Okay. We're not going to be using a credit card for anything. We are literally just This is what it'll look like. We're going to have your checking account at EECU Bank. Our PLOC is here, and our bills are up
In the
here.
HELOC.
Bills and debts. are here. So what happens is our income
Mm-hmm.
goes into the checking account at EECU. Immediately, I'm dumping my entire paycheck into the PLOC, right? I then pull money out of the PLOC of bills and expenses, right? And basically PLOC pays the bills and debts. That's what's occurring.
Okay.
And
Mm-hmm.
because we're eliminating bills
Right.
and debts over time, cash flow comes back into the checking and goes into the PLOC, right? And it creates this system of money in, money out. And that's what we're going to be having. Okay, that's what we're going to set up. So
Okay.
far, we got say about $4,000 that's going to go into the personal line of credit. It's going to bring the balance down to somewhere around this number, all right, once you factor interest and stuff.
Uh-huh.
And then we're going to deposit income. So we got 5,956 minus income. Balance goes down.
One quick question, Denzel.
Go ahead.
Should I put my checks every week when I get them? Would that help with the interest, or should I put them every month
You're doing
into
it
the PLOC?
you're doing it every week. So for you, it's velocity banking with weekly paychecks.
Okay.
So that means 4 to 5 times a month.
Correct.
Money goes in. Money goes into PLOC 4 to 5 times a month, and then roughly 5 to 7 times a month on average, money is coming out to pay your bills and expenses, right? So what you'll do is
Right.
every 3 to 5 days, make a withdrawal from PLOC to checking account, and that'll be going just like this: money in, money out, money in, money out, back and forth. That is helping reduce the cost of money on the personal line of credit, which means that the payment itself on the line of credit reduces every single month, which means more cash flow stayed in the PLOC, which means you paid the PLOC that much faster. Now,
Right.
what we could do from here is once the PLOC goes to zero, we have an option. I'm going to break down 2 options here. So I'm just going to illustrate how long it takes us, right? Starting in November, right? Starting in October, right? So October balance is here, even though we're actually starting in September, right? So minus income again, plus expenses. So we're at 4,000. This is January. What's going to happen is once we get to like January, February, you might have a paycheck or two that actually like it'll be like the credit line goes to zero, right? And so it'll feel like you
Huh?
paid it off. It'll feel like you paid it off, but just don't get confused. You still actually need to pull from it to pay your bills, right? So we're still going to, follow this all the way through
Right. Right.
till it gets to a true zero. Right, so initially you might hit zero on the PLOC. Don't
Okay.
get confused. You're not at a true zero just yet.
Because I have to pay bills.
Exactly. Now, if we make $5,400, right, a couple of these months, then obviously the line of credit goes to a true zero that much faster. And what'll happen is as you're getting close to paying off the line of credit, what you'll notice is you won't have to put all your income in because we're basically going to be weaning ourselves off of the PLOC where we're not going to have to run every single expense through the PLOC because it's nearly paid off. So
Uh-huh.
around March, April, let's say your cash flow is $1,000 in the month of April, right, or March, then
Uh-huh.
you basically wouldn't dump your income into the PLOC. You don't have to because you could just literally wait to the end of the month and then
Correct.
you can just pay off the line with cash flow, right? But I'm still gonna kind of illustrate what that
Uh-huh.
potentially look at here. So basically around April, right, at the end of April, beginning of May, we can literally say, all right, when my money hits my account, my paycheck hits my account, I'm going to pay my bills, right? And then whatever's left over at the end of the month, boom. So April is paid off. So we can say April or sooner paid off. Okay, so now we have an option. We have two options here that we could look at this point. Remind me of your age again. How old are you again?
I'm 46 years old.
Okay,
46.
gotcha. Perfect. So we'll go over options. Two options that we could look at that is definitely worth considering here once the PLOC is at 0. So again, option 1, velocity banking on PLOC to chunk at HELOC, right? To try to get that paid down. And as you get it paid down, it reduces the interest only payment, which creates more cash flow. Okay, simple as that.
Uh-huh.
Option 2 is we pay off PLOC, then no more velocity banking, switch to IBC banking. And all we're doing is saving money in a life insurance policy where your money's going to grow tax-free, guaranteed, safe, liquid. Now, around this time, according to our numbers here, if the PLOC is paid off, well, we no longer have that 538 roughly or so payment. It'll probably be a little less once you bring it up to current. So we no longer have that. Our expenses will go down about $200-$300 off of that PLOC now that we no longer have it. And our cash flow will be about $1,000 or more come April or sooner of next year. With that cash flow each and every
Uh-huh.
month, right? We literally can just fund a policy anywhere from 10 to say 12,000 a year. Okay? And we're not going to borrow from it. We're not going to leverage it. We're literally just building the principle of saving money tax-free in a guaranteed safe liquid location. We're getting a death benefit that covers all of our debts in case anything happens to you. Wife is going to be okay because she'll be able to take care of everything and it'll replace your income for a period of time. Then what will happen is if we go option 2 route, the HELOC will expire, right, on that period, and then it'll become a principal
Uh-huh.
and interest payment, which at 97,806, I'm going to times that by say 2% of the balance. Okay, the payment will likely double. Okay, so it'll be
Oh my
1,000.
goodness. Uh-huh.
So this is what I'm estimating that the payment will probably be around this number, right? If it's a 10-year repayment, right? A 10-year payback.
Okay.
Now, the other the
Okay.
other option that could probably happen is to get out of the 10-year repayment. There might be the option of making it like a 20-year repayment, right? So it makes the payment even smaller, but you obviously would pay more interest, right? And that might be what we end up doing because when that happens, if we're not making enough money to service that payment, then we go right back into negative cash flow territory again, right?
Right.
So if we do option 2, what we have to create, which I believe is possible, is enough income to supplement, to service a $2,000 payment on the HELOC. And then again, the other way around that is to negotiate with the bank. Instead of it being a 10-year repayment, that we can negotiate like a 15 or 20-year repayment plan with them to reduce the payment. Or worst case scenario, we do a refinance of the whole entire home, right? Where it combines the HELOC and your existing mortgage at a new interest rate, at a new payment, right? And that would be like last resort. I don't want that to be the case, but that would be the last
Uh-huh.
resort. Okay. Now the strategy basically with the life insurance policy here is you're growing an asset, number one. You're growing a tax-free asset, number two. You're building up savings, number three. You're building up a security. You're building up reserves, number four. And then 5 is once we've built up enough cash value in the policy, we would start to take loans, and we can use that to pay off the HELOC, which would be at that high payment, and that's a guaranteed amount of cash flow savings at a 8.5%, say fixed rate or something like that. I don't know, maybe the rate might drop a little bit 2 years from now, hopefully. But again, the payment is going to be pretty high on a 10-year repayment, regardless of the interest rate. It's going to be pretty high, probably double what we're currently paying. So it's probably going to be anywhere from $1,400 to as high as like almost $2,000 is what I'm guesstimating, right? In a
Yeah, more than
10-year
my house payment right now.
payment. Yeah. Matter of fact, I'm gonna go on the internet and just look up a amortization calculator real quick. So amortization calculator, and we're gonna put some numbers in. I'll share my screen so we can take a look at this together. So let's say the loan amount, 97,000, 10-year repayment.
This is if we don't pay any extra in the next couple of years,
Correct. No extra
right?
payments because we're focusing all on the PLOC, so we're not paying anything extra to the HELOC, right? So, yep. So the monthly
Okay.
payment, okay, it's much less than I thought. So let's see if it's 8.5%. Let me calculate. All right, so it's much less than I thought. So 97,806 on 10-year repayment. The monthly payment is $1,212.65, right? And we pay a total of
So
$46,000
we're
in it.
not gonna be
Say again?
chunking from the PLOC to the HELOC. And in this
In
case, we're not gonna be making chunk.
in option 2, no, not out the gate,
Okay,
not right away. So here's what we would do. I'll
got
show
it.
you. So I'm going to change this. So this is actually way more doable now that we have a better idea. So it'd be
Uh huh.
$1,212.65. Let's say our expenses went down from 425,932 minus PLOC payment. I'm just gonna minus like 250. Okay, so let's say we're at 4,000, $50, and let's say we're making $5,400 on average minus 4,050. So we're cash flowing 1,350. Cash flowing 1,350 come April. This is the goal. This is where I want you at. By April 2025, 1,350. Okay? If we can consistently be at that number and the HELOC doesn't expire till 2026, correct?
Right.
All right. Do you know which month it expires?
I think we just passed the mark in August. I think it expires in August of 2026,
Okay, got it.
but I could
So
always check the paperwork.
from 2025 April to 2026 April, we could cash flow about $16,200. And let's say we sent 10 to 12,000, I'll use the lesser number, to fund a policy. So 10,000 funds a policy, which means we're left with $6,200 as cash. What we could do is simply save it in a high yield savings as emergent, like an additional emergency fund, and that would cover about almost 2 months of emergency.
Okay.
The other thing that during that window from April 2025 to April 2026 is we could use some of that. So I'll say cash reserves and pay off car right here to get that 235.76, right?
Okay.
So then
Yeah.
come August
2026.
2026, we'd have that payment roughly 112.65. Our cash flow by
In the
then,
HELOC.
I'm gonna do 4,050. I'm gonna minus 235.76. So our expenses should be somewhere around this number, 3,814.26. And if our income is 5,400, which by 2026 I would want our income higher than this, since this is being conservative. So 5,400 minus
Uh huh.
3814.26. So this is being conservative. Cash flow at 1,585 minus 1,212.65. So that would bring our cash flow down to 373.09 times 12. That's only $4,400. Ideally, I want your income to be around $6,100 by 2026 August, which is very possible to do, right? Working in the same industry that you're in, it's very possible to get up to that number. And we minus expenses, 381426 minus 121265. Cash flow is at 1,000. So even with that HELOC payment coming in, I would want our cash flow to be at least at $1,000, because if that's the case, I could still fund the policy at $10,000 a year.
Okay.
In 2025, this is what I would want: $10K funded. 2026, another $10K, and then 2026, the payments start. And in that year, we could probably take a loan out. I'd say around 13 grand. Do a loan for like 13K, and we would send it to the HELOC balance to knock it down, right? So we would be
Which by
using,
then will be way less.
it'll start, yeah, it'll start to, come down a little bit. So what is happening is we're using the life insurance policy, which is an asset that we can borrow against, to pay down the HELOC at that 8.5% or whatever the declared rate is, at whatever the payment is, right? And we can start to pay that down while simultaneously building wealth through this asset. And we would take about maybe say 3-4 years of doing that. So we're saving money first, then we borrow to pay down the HELOC, or we could simply wait and just build up the cash until we have the option to do one check to pay off the HELOC in full. All right, so we'd still making the payments. We're cash flowing at least $1,000 ideally by August of 2026, right? And we're still able to fund our policy 10K a year. And then after this gets built up, enough cash value, like 50, 60, 70K, we could do a loan and eliminate this loan. Instead of having it for 10 years, we could eliminate it in about 3 to 4. When that's done, your cash flow goes back up that $1,200. And when that happens, we can send our cash flow that keeps funding the policy and starts to pay down the loans in the policy. And then again, so we go from 46 years old to about 50, 51. We're building an asset. We're thinking on, getting ready to retire 10, 12 years out from that point. And we got a nice asset going for us. And in that time, between 46 and 51, we are maximizing income, right? What are your skills, gifts, and talents? How do we create value in the marketplace? Get you paid abundantly? How do we double this income, right? Because the more income I can bring in, the faster all of this is gonna go, right? So that's what I see personally with this strategy. That was option 2, okay? Option 1, going back, was velocity banking on the PLOC, which is still option 2, right? Until the PLOC gets paid off, which would happen around April or sooner. From that point, from 2025 all the way to 2026 and even beyond, we're using the PLOC to chunk at the HELOC. And in that scenario, if that occurs, you're guaranteeing that by August of 2026, when the HELOC expires and it becomes a regular payment, it won't be 12/12/65. It'll probably be like $1,000 or $900 payment, because you've already been paying down the principal balance in advance. Does that make sense?
Right.
Then what we could do for the sake of option 2 is we would buy a convertible term policy that is cheaper in cost but gives us a healthy death benefit, right? and basically would allow us to do option 2 but just years later. So this convertible term
I
policy.
don't understand very much about um,
Yeah, no, that's okay.
life policies,
Yeah, I'm gonna
so
explain. I'm gonna explain.
it scares me
So
a little bit because I don't know much about it.
right. So convertible term policy, right? Let's just say we got you a half a mil to a $1 million death benefit at your current age between 46, 47, right? So it'll decrease our cash flow a little
Okay.
bit, not by much, and we're just basically buying life insurance, right? We're securing your human life value and protecting all that debt. In the event something happens to you, wife has enough money to pay off all the debts and enough income to replace your income, right? So it solves for that piece right there,
Okay.
which is buying life insurance. Now, the benefit here is because we secured life insurance on you at say 47 and we were doing velocity banking on the PLOC to the HELOC, and let's say that took us 3-4 years, by the time we're 50, maybe 51, we could convert this term policy into a whole life policy and then fund 10,000 a year. Let's just say you can do something like that. But the advantage here with option 1 is you're able to do option 2 at the same cost, right? In terms of cost of insurance, because you're locking in your health rating at
Okay.
47 instead of 50 or 51, okay? So
Yeah, makes sense.
option one is technically safer than option 2. It's safer and it provides more guarantees, considering that if we start hammering
Right.
at the HELOC balance before it expires, even if it went down to 90 grand, right? Let's look at the amortization calculator again and see what impact that does for us. So if it was at 90,000 and let's say the interest rate is 7%, what that does, look what just 7 grand does, and one less interest point, right? A point and a half less. So it brings our
Right.
payment down to $1,000. Well, let's say you were able to do 2 chunks
Uh-huh.
of $7,000, right? 97,000 minus 14,000,
83, around 80.
83, right? So now it's at 963.70. Okay. So we create a
Not much.
lesser burden, right, on the monthly obligation payment, right? And then once that payment kicks in,
Right.
say it's around $900, we're still using the PLOC to make chunks to the home equity line of credit, right? We would still, keep doing that.
Yeah.
At some point we would most likely stop. A matter of fact, we probably would only do that chunking until the HELOC expires, because whatever the interest rate goes to, it's most likely going to be too far away from your interest rate at 12.75%. So in that case,
Yeah.
we'll probably just make extra payments on top of the 900. So you'll probably be doing $900 payment and then probably make another $900 payment. So you're probably paying like say 2,000 a month to the HELOC every single month as extra payments. It's probably as simple as that until we get that knocked, down. And again, at that point,
Mm-hmm.
at some point in time, with option 1, we convert the convertible term policy into a whole life and start saving money in here first before you pay down your HELOC, right? Because if all we do is pay down the HELOC, that's all you did is pay down the HELOC and remove the debt. But we still have the problem of
Okay.
we need to create wealth, we need to create lifetime income, we need to get ready for retirement. And so we're losing time, right? Whereas option 2, the advantage here, it involves a little more risk, right? But I really don't really look at it as risk. I don't think it actually increases risk. It's just a different way of saving money. We're either saving money for the future or
Saving.
saving money now, right? Just getting the whole life now at like say 47. and just getting that going. You could say the risk is, well, Denzel, I'll have a higher payment, right? So basically, our decision will become more clear between one or two when we get to August 2026. That's when this will become more clear. We'll be like, okay, Denzel, now I'm making $6,000 a month and my expenses are under 4K. So I'm perfectly okay with servicing this payment, right?
The HELOC payment.
I can do that. I can cover that payment, and I'm gonna save my money over here first. And when I'm ready to start making lump sum payments to start knocking down that HELOC, I'm gonna do it from the policy. But I'm saving money first, which is building this asset, which is gonna provide more benefits in retirement. Okay. So our focus for right
Okay.
now, right? We're not gonna get too obsessed over here. This is just looking out into the future, right? Our focus
Uh-huh.
is PLOC, pay it down, do velocity banking, no use of credit cards, no leveraging, no applying for anything, no distractions, maximize income, work overtime, spend less money where we can, be a good steward, avoid distractions, avoid money making opportunities, avoid get rich quick stuff, right? Avoid it all because that's what got us here in the
Mm-hmm.
first place. They took advantage of our desperation, they took advantage of our vulnerability, they took advantage of our lack of knowledge, right? So now that you have an accountability partner,
Right.
if an income opportunity does present itself, we're going to go through a process. We're going to go through a decision making process to evaluate that opportunity to see if it's a right fit for us or not, right? If it sounds too good to be true, probably
Okay.
is. If it if it says some things like, no work, you don't have to worry, and extravagant rates of returns, 25% rate of return, and all this stuff, it's probably too good to be true. What we
Yeah.
can focus more on is what is the Father's will over your life? What's your purpose? What's your skills, gifts, and talents? How do we use those skills, gifts, and talents, bootstrap ourselves from the ground up, do a grassroots approach to fine tuning, sharpening those skills of yours to increase your activity income to the level that we feel comfortable saying, okay, Denzel, now that I have $2,000, $3,000 in cash flow a month, I want to save 10,000 a year over here in this policy, and I want to send $500 a month to this investment account. I want to start investing in the market, or I want to start learning how to invest in real estate. So I'm going to buy this course, or I'm going to buy these books, or I'm going to go to this mastermind and I'm going to learn how I can invest and grow myself to start building assets so that by the time I reach 59 and a half or 65 or sooner, I'll be completely set up. So that's our goal here, that by
Okay.
April or sooner, I want that PLOC paid off. I don't care if they lower my credit limit. That's not a concern for us. If it happens, whatever. My
Yeah.
focus is still paying it off, right? And if I pay it off and they
Right.
close it, if I pay it off and they close it, I still don't care. If I pay it down and they lower the limit, I don't care. As long as I get this PLOC paid off by April or sooner, I'm going to be happy. And then between April 2025 and August 2026, we can either buy a life insurance policy starting April of 2025 and we start saving money every single month in this policy, or we just start making extra payments to the home equity line of credit, getting that paid down. Either or is going to get us good results. So we'll make that decision next year around April. In the meantime, this is our focus. We're avoiding distractions. We're going to hold each other accountable. We're going to have phone calls periodically, right? This will be saved, sent to you so you can review. This is your
Okay.
template. This is your guiding tool. This is your measuring stick. You say, okay, I'm on track. I'm on track. I'm on track. I'm ahead, right? Out the gate, we should be ahead,
Yeah.
right? End
Okay.
of October, you should be ahead of 5,200. You
Yeah.
should be less because I didn't even factor in the results in September. Okay. Any
Right.
questions? Any questions?
Yes. Yes. I have a couple questions. Um, when you said on the PLOC, the 4 to 5 times a month, oh no, 4 to 5 times a month.
Money goes into PLOC. That's your
No, every
paychecks.
3 to 5 days.
Yeah, every
No,
3 to 5 days.
yeah, down there. Every 3 to 5 days, I need to withdraw money from the PLOC. Why would I do that
To pay your bills.
instead of monthly? Because I pay my bills every beginning of the month. I pay everything
Right. So we're not going to do that no more.
besides the
We're
house.
we're right. We're going to pay our bills
Okay.
when they're due, right? We're not going to pay our bills ahead of
Okay.
time.
Okay. I got
We're
you.
going to
I got
we're going to pay when they're due because that means more money stood in the personal line of credit as long as humanly possible. Now, granted, you might have a lot of
you.
bills
Lowering
due.
interest.
Yeah, yeah. You might have a lot of bills due at the beginning of the month, and that's totally fine. We're going to pay those bills. But when it comes to gas and groceries and different subscription payments and phone bill, light bill, things like that, whenever they're due, you just pull it out of the PLOC to the EECU checking account, pay the bill, right? And when the
Okay.
when the
Okay. I
paycheck
got you.
comes in,
Hmm.
you immediately push it back in. So get that done first, and then we'll get this process going. And then in the meantime, you'll move 4,000 from your savings into the PLOC, right? So it can create that gap, that little space there that we
Okay.
need to actually get this going. All right.
Okay.
Anything else?
All right. That's clear now. Yes. About life insurance. I have a couple of policies with work through my union, one for myself, one for my wife. Uh, of course, my 401k retirement account,
Yeah.
which the
Send that all to me.
forecast says, I don't believe,
Yeah, send that all to
it
me.
says I'm getting a retirement. I get like 4,000. Okay. I'll send you a statement of my 401k and check more into the life insurance policy so you can see it. And because it's there, I'm paying for it.
Yeah.
And that's another thing. And the last question I have, well, another question I have is about the IBC or the other account you said, the other life insurance policy.
Yeah,
I don't
converted.
understand very much about those,
That's
how
okay.
to work. Yeah, but like you said, we're not gonna worry about that right now. We're going
Correct.
about the first focus.
Yep.